Going on, everybody? Welcome back. On today's video, I'm just going to talk about the slight variations or differences with breakout trading and retest trading. Now, this is just a disclaimer. I have nothing against breakout trading, and I don't have much experience in breakout trading, but what I'm going to do is just take the logic behind the way I think and explain it to you. Remember, not every video I'm going to do you're going to resonate with, and if this is not the one, then for sure just leave a comment down below and let me know. But what I wanted to just do is clear out the elephant in the room, because a lot of people are asking, well, if you know it's going to break out, then why can't you just take the trade if it's going to make a new higher high? Well, let's just take a look at this. This is an example on pound USD. What I'm identifying here, first things first, as you all know, is this is an uptrend. Higher highs, higher lows. Now, the market has created a higher low on this structure, and this has been indicated by multiple hourly wick rejections. They look very juicy, and yes, they look like we could just jump in right now and take the buy, and the market's going to fly up. But what we need to consider before buying this market, even with these pin bars or even with these strong bullish candles to the upside, is that price may struggle to break above this area. Now, you might say, well, hold on, but if it breaks above, then I'm going to miss the trade. Well, no. You have to understand that every trade you take needs to be systematic and in line with a strategy that you're using. So let's say your same thought process was here for this higher low. Look what the market done first before it went up. It found a resistance. Now, let's say this market never made the higher low and continued up and went down. You would have been stopped out. Let's take a look at another example. Look here to the left. Let's say you're now identifying this as a higher low or potential double bottom on the market. Look what happens. Price finds it very difficult just to break through to the upside. Now, is this a risk that you're willing to take? Are you going to take a trade as a higher low, lower high, double bottom, double top, when you know there's potentially an area in the market you're going to run into problems? If you do, then it's up to you, but the point is, it's better to allow for price to clear the structure. So when we're looking at this example, what we want to see is price breaking above this level. Now, if we're not taking a trade here because we might be finding some sort of resistance, or we might be finding a level in the market where price is failing to break above, then what we need to do is wait for the breakout. Now, those that are waiting for these breakout trades will then say to themselves, well, now it's broken out, it's time to buy the market. What you're forgetting is that the higher low was formed at this point, not this point. But the reason why you avoid taking this trade is just in case price doesn't break above this level. Does this make a difference? Well, absolutely, because now if you plan to take this trade, you're taking this trade as an instant execution above structure. For those that are breakout traders, and you're going to be placing your stop loss where? If you place it below the structural level, then you defeat the object of trading, because we know that price is allowed to come back in and around this level for as long as it wants before it decides to go up, just in case the price action pulls back for a little bit of breathing space, collect some more orders, come back for a double bottom before it goes up. If you have your stop loss below this structure, then on every occasion you're going to get yourself stopped out. So this is a very unsafe stop loss. If now we decide to place a stop loss below this structure level, look what happens to our risk to reward ratio. It becomes ridiculous. just look at it from a visual perspective. The stop loss range is huge. Now, what does this mean for you? Well, yes, you do have a safer stop loss because now it's below structure like we've just said. But now it means that you have to increase your reward size. And what does that mean for you? Well, you're probably going to sit in this trade for, let's say, donkeys of days. And if you're patient enough to do that, then by all means. But what you're then failing to recognize is that once price breaks out of this structure, you now have entered a push phase, which means the market is going to want to pull back again to make a new higher low before it continues up, pull back to make a higher low before it continues to go up. And the more time that passes, you then increase the odds of the market reversing on you. So let's play this scenario out. Let's place our stop loss below this structure. Let's go for a 1-to-3 risk to reward ratio, and let's see what happens.
Nhập khẩu nguyên chiếc từ Thái Lan, MG sẽ có sự mã đắt mới.
Okay, so we have a stop loss. Now, would we have managed that to break even? Most probably. Let's keep it real. We're not trying to play games here. I'm just trying to illustrate a point, not to try to prove that I'm right. So this would have been a break-even trade. Let's do this one more time. Let's say now we have our stop loss below structure. We go for a 1-to-2 risk to reward ratio. And let's see how this one plays out. And there you have it. On this trade also, you may have been break even, okay, whatever, not the point. What I'm saying, you're decreasing your chances of hitting those take profits with these breakout trades, because what happens is once price leaves the higher low or the lower high area, or the double bottom and double top area, guess what happens? The market has already entered its push phase, which means it's more likely to exhaust and then create a new high, low, lower high before it continues up or down. But once you enter these trades late, you're then increasing the chances of your stop loss being much bigger, because you need to use the range of the market to have a safe stop loss, and then that increases your chances of potentially finding yourself in a reversal phase. So why do we wait for the retest? Well, we wait for the retest so that we can allow for price to come back to a key level in the market and show us a sign earlier rather than later. So when we take this information, what we're looking at is price has broken this structure. I'm simply looking for price to retest an area on this market where I believe it will react to. And where is that normally going to happen? Well, it's going to happen at its lower highs, its higher lows, or previous areas where price is broken through, retested, and created a reaction from. So if we wait patiently for this, let's remove this level here, because at the moment this market is in a push phase, which means we're not selling this market. We want a clean retest as always, and we're going to just allow for price to come back to a level in the market. As you can see here, we understand the phases of any market structure, which is a structural high, lower high. We have the level where price broke above the previous high before. We have a level where price retested that, and now we have a breakout of that structure. Again, we can't take this breakout, because if we're looking to take this breakout of this structure, then again, what happens with our trade? we need to put our stop loss above this, and now we decrease the odds of us being able to hit that take profit with this big stop loss range and terrible risk to reward ratio. So we wait for the market to come back, retest the level, give us true confirmation of a retest, stop loss above the structure, and then we go for our targets. Obviously we want to make sure we're locked in before price gets back to this level, because this is a level where price can react to, and then we just play the trade out and we see what happens. And there you have it. Probably would have got more out of that, but let's just keep it simple, 1 to 3 very easily. But you see the difference. Now we have a smaller stop loss, a smaller TP range. We have confirmed evidence of the market breaking the structure. We have a high, lower, high formation, a retest, and as opposed to waiting for these breakouts, having a huge stop loss range in a very extended market or in a strong push phase market, we avoid the odds of being stopped out, and we can take advantage of much more of the range of that single move, as opposed to floating in a trade for a very long period of time. And that's exactly what happened to me on Euro USD this week. On Monday, I took a trade in and around this area here for a sell opportunity. My first position, I managed to close out at 30 pips. My second position, I managed to close out around 40 pips. And my third position, unfortunately, was all the way down here around 50 pips, and I still held the position. And then what happened? The market turned against me. Now, why did it do that? Well, in any market structure, the market is going to always push and then exhaust. We never know how much the market's going to exhaust. So for that reason, in this stage of my sell, even though I took 30 pips on one position, 40 on the other, I didn't close out the 50 pips. But what happens is the market will push, and eventually exhaust. Now, do I expect the market to blow to the upside like this? No. I'm expecting it to at least respect some sort of levels and make a lower high before a continuation if I